And a warm welcome on KTN Business. My name is Abi Agina. We start off from the banks. They have earned an unsavory reputation over the years from the perception that they make a lot of profit by fleecing both depositors and borrowers. But now it seems it would be that MPs are looking to make a third attempt to rein in the banking sector. Adelaide Changole reports.
The year is 2001 and the Member of Parliament for Gem constituency, Joe Donde, has just published a private member's bill that seeks to tame the real interest rate spread in Kenya, which at the time is among the highest in the world. The MP sought to cap interest rates chargeable on loans to a maximum of 4% of the prevailing 91-day Treasury bill rates, while the deposit rate was to be no less than 4 percentage points below the T-bill rate. As was to be expected, the bill received widespread opposition from the banks and the donor community. Despite sailing through Parliament, the bill never saw the light of day. In 2012, Gem MP Jacob Midiwo sought to amend the finance bill to cap lending rates at 4 percentage points over the central bank rate and deposit rate at 70% of the benchmark CBR. But just like the previous bill, this too flopped. Despite this, banks remained in the spotlight, with regulators worried about the high spread between what the banks pay depositors and their lending rates.
Trades of this magnitude generally happen after you have had a banking crisis.
In a move to deal with this, the central bank unveiled the Kenya Bank's reference rate last year. KBRR is based on an average of the CBR rate and the 91-day T-bill yield over a 6-month period. Banks are required to price all loans using KBRR as their base rate and K to represent the risk premium unique to every borrower. But it would seem that legislators are not satisfied with this. The MPs have now launched a brand new effort to control interest rates. Waluke wants to amend Section 36 of the CBK Act to compel banks and microfinance lenders to cap borrowing rates at 5 percentage points above the central bank lending rate. But the prospective governor and deputy governor of the central bank have warned against the move.
To fight it directly against the banks is not really going to be a very sustainable way. We can win for a while, but we will not be sustainable.
They say the answer lies not in capping interest rates, but rather in reducing the factors that increase risk and increasing competition in the banking sector. The draft bill will be scrutinized by the Finance, Planning and Trade Committee, chaired by Ainamoyo MP Benjamin Langat, before it's published and formally introduced in the House. Adelaide Changole, KTN Business.